It is 4:47 a.m. The conference room has no windows. You are sitting at a table made of dark glass in a building in Midtown Manhattan, 42 floors above a street that is already moving. A term sheet is in front of you, $4.1 billion. Senior secured notes, coupon at 7.25%. The issuer is a sovereign government. The use of proceeds section reads General Budgetary and Operational Requirements. You know what that means. Everyone in this room knows what that means. Nobody says the other thing out loud because at this level, language is a precision instrument, and precision means you only say exactly what the document requires. The lead banker slides the signature page across the table. You pick up the pen. You do not hesitate. You sign. The wire will move at market open. $4,100 million will transfer from a consortium of institutional investors, pension funds, sovereign wealth funds, insurance company reserves, to a government that will use a portion of it to sustain a military operation in a region that closed its airspace 17 days ago. You did not build the conflict. You built the instrument that finances it. You fly home at 6:15 a.m. on a car service your firm pays for. You sleep for 3 hours. You are back at your desk by noon. You did not start here. This is what it takes to get here and what it costs and what you become in the process. Your first morning, the badge was still warm from the laminator. It had a faint chemical smell, laminate and fresh ink. The kind of detail you register once and never again because it becomes part of the permanent texture of a place, and the human brain stops processing what is permanent. You will learn over the next decade that this principle applies to more than badges. The lobby was cold, deliberately cold, the kind of climate control that signals resources, that somewhere in this building's operating budget, comfort is not the priority, and the temperature is calibrated to keep people alert rather than relaxed. You were 23 years old. You had a Bloomberg terminal you did not fully know how to operate, a financial modeling course certificate from an online platform, and the specific variety of ambition that comes from growing up watching someone work hard at something that never paid them what it cost them. You were going to do the other thing. You were going to understand the architecture of capital before it processed you. The senior analyst who walked you to your desk said, start with the prospectuses, learn what a duration mismatch looks like, and don't ask questions in the first 30 days that you could answer yourself in the next 30 minutes. He walked away. You opened the terminal. The data began. The first level is constructed entirely from volume. You read everything. Sovereign bond mechanics, the yield curve and what it signals about market expectations for growth and inflation over a 10, 20, 30-year horizon. How a 50 basis point shift in the benchmark rate affects the present value of a 30-year bond, not conceptually, but numerically, specifically in a live position. You build discounted cash flow models with assumptions that your associate corrects without explanation, which is its own form of education. You learn to read a government's fiscal position in its debt issuance calendar. You learn that the spread between a sovereign's bond yield and a risk-free rate is not just a number. It is the market's collective judgment about the probability that this country will still be functioning in the way it currently is when the bond matures. Some of the countries on your coverage list are at war. You model their debt service coverage ratios. You run scenarios. Conflict extends 12 months, 18 months, 36 months. What does the primary surplus need to look like for the yield to hold? What is the restructuring probability at each interval? You build the output into a clean table, color-coded. You send it to your associate at 11:31 p.m. He responds at 11:32 p.m. One word, good. You go home. You eat something cold from the refrigerator. You set your alarm for 5:50 a.m. You lie in the dark for a while thinking about the yield curve. You think this is what dedication looks like. You are partially right. Month 9. You understand the product now, not analytically, physically. The way a mechanic understands an engine, not from the manual, but from the sound. War finance is not a metaphor. It is a specific, documented, centuries-old mechanism. When a sovereign state enters a military conflict, its expenditure curve separates from its revenue curve immediately and dramatically. Tax collection does not accelerate during war. Procurement does. Logistics does. Personnel does. The gap between what the government spends and what it collects requires financing. And financing at sovereign scale means the debt markets. The government issues bonds. It sets a coupon, a maturity, and a structure. Your firm runs the book. You find the buyers, the institutions managing retirement savings, university endowments, the reserve assets of other sovereign nations, and you price the instrument at a yield that clears the market. The buyers receive an interest-bearing claim against the future revenues of a state. The state receives the capital it needs to continue operating. The bond does not know what the capital is used for. The bond does not care. The bond is an instrument of indifference, and that is precisely what makes it functional at scale. You rationalize your role efficiently. Capital flows to conflict regardless of whether you participate. The question is not whether this financing happens. The question is whether it happens through a regulated, transparent, legally documented structure, or through something with no documentation, no oversight, and no secondary market that prices the risk publicly. You are the transparent version. You are the version with documentation. You hold on to this logic for approximately 2 years before you stop needing it. Year 2, Frankfurt, then Abu Dhabi, then a government building in a city that does not appear in your expense report. You were on your first live deal team, not the lead, the support. You build the models that the managing director presents. You prepare the sensitivity tables. You sit in rooms where decisions worth hundreds of millions of dollars are made in 40-second conversations between people who have known each other for 15 years. And you watch how those relationships function, how information moves, how trust acts as a financial instrument at this level, not metaphorically, but literally. The difference between a $600 million order and a $200 million order from a particular investor is often not the yield. It is whether they trust that your managing director will call them before the next deal comes to market, whether they are inside the information flow or outside it. Proximity to capital is not an accident at this level. It is an architecture. It is built over years, maintained through dinners, phone calls made on Sunday evenings, the specific signal of being remembered by name in a room full of people who could be forgotten. You are building your architecture, brick by brick. It costs you your late evenings, your weekends in the first half of the decade, the relationship that ended in year 3 when she said she felt like she was competing with a building, and she was correct. And you both knew the building was winning. You did not fight it. You told yourself you would address it later. Later was a budget you spend without tracking. Year 4. The title says Vice President. The apartment has a doorman now. You own 3 suits that cost more than your first month's salary. You have a cleaning service that comes on Thursdays. You have stopped doing things that require your full presence and return nothing measurable. You are on the secondary market desk. This is the afterlife economy of war finance. The bonds issued during a conflict 2 or 3 years ago are now trading in the secondary market, buying and selling between institutional investors based on current risk assessments. A ceasefire rumor moves the price up 6 points in a session. An escalation moves it down 9. You are in the middle of this flow, connecting buyers and sellers, earning the spread. You track the conflict on your terminal the way a meteorologist tracks weather, not with feeling, with calibration. When violence escalates in the 3rd quarter, your desk's revenue is up 23% year over year. You include this in your performance review. It is a clean number. It fits in a cell. It belongs to a column labeled Revenue Contribution, and it is green. You call your brother on a Saturday. He asks how you are. Busy, you say. You're always busy, he says. I know, you say. And the conversation moves on, and neither of you says what the conversation was actually about. Year 6, the architecture shifts. You are not executing anymore. You are structuring. You have sovereign clients now, not companies, not funds, but governments. And they come to you not just for execution, but for design. How do we access the market without triggering a credit agency review? How do we extend our maturity profile without signaling distress? How do we finance this gap off balance sheet in a way that is legal, documented, and invisible to the secondary market for 18 months? You sit across from a deputy finance minister in a private dining room in Mayfair. No menu, a set meal, no other guests within earshot. He needs $5.8 billion over 14 months. He cannot come to the public market directly. You design a structure involving a special purpose vehicle registered in the Cayman Islands, which acquires a portfolio of government-guaranteed export receivables and issues asset-backed notes against them. The structure sits off the sovereign's primary balance sheet. It is rated separately. It accesses a different pool of capital. It is fully legal. It is thoroughly documented. And it functions because the people rating it and the people buying it and the regulators who will eventually review it all operate within the same shared framework of what documentation means and what visibility requires. You are not hiding anything. You are engineering the angle of the light. The minister signs the mandate letter over dessert. You fly back to New York on the first morning flight. You sleep for 4 hours across the Atlantic. You feel, in those 4 hours, something that resembles satisfaction. It is the last time that feeling has a name you can identify easily. Year 9. You wake at 5:30 a.m., and the tiredness is no longer a sensation. It has become the medium you operate in, the way a deep-sea creature operates in pressure. You are not tired in a way that contrasts with rest. You are tired in a way that has become structural, ambient, invisible. Your therapist, whom you see at 7 a.m. on Tuesdays because there is no other slot that does not conflict with live deal flow, asks you when you last felt surprised by your own emotional response to something. You think about it carefully. You rebuild the memory. You change the search parameters. You wait. Nothing returns. She writes something in her notebook. You check your phone. Year 12. Managing Director. Your deals are priced in 10 figures now. Your name appears in the Financial Times in the small print below the transaction announcements. Not your full name, your initials, your firm's name, and your role. That is the correct amount of visibility for this work. This work does not benefit from visibility. Visibility creates friction. Friction slows capital. You were in Zurich for a sovereign debt restructuring. A government that financed a prolonged conflict through multiple bond issuances across 3 currencies is now unable to service its obligations. The debt-to-GDP ratio has passed the threshold where the market no longer prices recovery. You are representing a creditor consortium holding $12.3 billion in outstanding notes. The restructuring terms you negotiate this week will extend maturities by 7 years, reduce coupon rates by 280 basis points, and impose primary surplus targets that will govern this country's fiscal policy for the next decade. You understand this. You sit down. You open your folder. You begin. At this level, the categories change. You are not navigating the system. You are not even operating within the system. You are part of its load-bearing structure. When your pricing assumptions shift by 30 basis points on a sovereign issuance, budget models change in finance ministries on 3 continents. When you decline to lead a book, the issue is cost of capital rises, and the market reads the signal and adjusts its own position accordingly. When you agree to structure a deal, you are not just providing a service, you are providing a signal. You are telling the market that this credit is defensible, that the risk is priced, that the capital can move. Information flows in both directions at this level. You shape what the market knows by choosing what you will and won't touch, and the market shapes what you know by showing you every day at granular resolution what risk actually looks like when it is priced without sentiment. Sentiment was the first thing you exchanged. You traded it in year 2 for access. Access became proximity. Proximity became architecture, and architecture eventually became something without a personal pronoun. You were not happy. You were not unhappy. Those categories dissolved somewhere around year 8 and were replaced by something more functional: orientation. Positioning against risk, the continuous calibration of where you stand relative to the moving geometry of a system that never fully rests. You are well positioned. You are correctly oriented. On most days, that is sufficient. On some nights, in the back of a car crossing a bridge in a city you're visiting for 30 hours, you look out the window at the people below. You feel the distance. Not painfully, just accurately. Like reading a spread, you are 54 years old. The firm offers you an advisory structure, reduced operational load, 2 board seats at institutions you have worked with for 20 years. You accept. You write a brief internal note. You do not have a farewell event. People at your level do not have farewell events. They simply stop appearing on the deal distribution lists, and the market adjusts, and the next person steps into the position, and the spread holds. On your last day, you take the elevator to 42 for the final time. The lobby is running, the climate control is running, that precise cold. There is a young man at the reception desk, 23, maybe 22. He is holding a badge that is still warm from the laminator. He is looking through the glass at the trading floor with an expression that is composed of equal parts fear and hunger in proportions that only exist before a person learns what each one costs the other. He does not see you. Why would he? He is a person leaving. He is a person beginning. In 12 years, if he gives the system what it requires, his hours, his sleep, his privacy, his relationships, his 20s, and eventually the version of himself that still needs things to have names, he will stand exactly where you are standing, outside the machine, having passed through it completely, changed in every dimension that isn't visible on a term sheet. He adjusts his badge. He walks toward the desk. The terminal glows. The capital moves. The system does not register the transition. It never does. The capital is permanent. The people are not. If you want to understand the architecture, not the surface, not the narrative, but the actual structural logic of how global capital moves, who controls it, and what it costs to be close to it, subscribe. Because this is what we do. We go underneath every time.